As I said, we'll have another quiz today, chapter 2. You had one on Monday, last class. I will take the higher of the two grades. I want to make sure you have a firm foundation in this stuff. I want to go through that content, and it's a 4-question quiz. I want you to really understand. We'll actually review the quiz itself as well as a follow-up. We can review Mondays as well because midnight is when it opened up. But we're going to start with a quiz, but I do have 2 other announcements to share. One is, hopefully you'll be coming on Thursday. Tomorrow is our big data night at 6 o'clock. I don't know how many of you, quick show of hands, how many have seen or met Dr. Hari before? Dean of the School of Business. Okay, it's not like the principal's office. It's a good thing you met him. It's something that we want to be able to do. And he'll be there speaking about big data at 6 p.m. He starts at 6:30. At 6, we have an alumnus coming in. Zach will be speaking on the field of big data as well. So we're excited to have him join us and talk about the concept, the ideas, the opportunities, because we're all going to be exposed to big data. Big data is just any kind of evaluation. There's so much information out there. We're all suffering from information overload. And the Accounting and Finance Club, the AFC, thought it'd be a good topic to share. And this stuff you're doing on Tableau in this class is big data. You're interpreting big data. And you'll be doing that again the rest of your career. We'll also be talking about the President's Bowl tomorrow night. But if you're interested in joining the team to compete, that's also good for extra credit and professional activity credits as well. So those are things coming up. I also received by mail, you might be able to see this packet of annual reports. Quick show of hands. How many of you actually received your annual reports that you've requested? How many have gotten them in stock? I know in my last class, some got them. Most of them I received directly. I guess they're saving on postage. So in the class, there's the plastic wrap with a cover sheet for every student that's requested. And by the window in the classroom, I have 2 boxes, A through K, L through Y. And you should have, if you haven't received them, your badge or annual report should be there. If you can find a way to stop by the classroom by Wednesday of next week, we'll give you a week cover to get there and see if you can pick up your packet. It's alphabetical by email address, not first name necessarily, not last name necessarily, whatever your email. So mine was scott.dell. I'm under S's, and again, it's alphabetically filed in these plastic packs. Once you get them, I want to be able to use them in the classroom, realign your reports. So please arrange to stop by if you're in class today. Obviously, you can pick them up on your way out before you head home, but please make sure to grab those. You have those. They usually were pretty good about sending directly to people that gave the address. Last semester, I got a request saying, can you coordinate and organize? I said, but people are at home. Can you just mail them directly? And they did. I guess this semester, most of them are coming to me. 2 huge boxes that came. So they're in the classroom. They're by the window on the far side, opposite the door. Please come and get them. Pick them up, go forward. All right, go ahead into Blackboard, or if you need to, go into Connect and start your quizzes. Take it away. I'll pause the recording. We'll resume when we get back together again. About 10 minutes, 4 questions. Well, let's take a look at the quiz. Let's review it in content, make sure we're all on the same page. I'm going to go ahead, share my screen, and we'll take a look at this quiz that we're working on. We have, we're going to preview it, we're going to take a look at it. I'm going to go question by question to make sure we're all on the same page. So what we have here, you buy office supplies on credit. What's the journal entry look like? Well, the easiest way to solve these kind of problems is write out the journal entry, and then you'll figure it out. So you bought supplies on credit. So new share, we're going to pop the whiteboard on screen, and we're going to take a look at our T account. You've seen this before. Let's see it again. Well, we're actually going to do the journal entry. So let's say you bought $500 worth of stuff. With the instructions, write down the numbers. Figure out what accounts are going to get hit. Is cash being hit here? Let's see, it says, no. We're going to buy supplies on credit, so cash isn't being hit. But supplies are going to get hit. And if we're buying supplies on credit, so we're making purchases, which means we're going to owe the money. Here's your attendance question. Is that accounts payable or accounts receivable? We're buying supplies. We owe the vendor money. We're not paying them yet, but we will. In the chat, please record either accounts payable, AP, or accounts receivable, AR. Are you able to get in? Do you have a phone? You don't have to, just go into zoom.us, phone number 608-446-1000, and password 25. I've got the survey chat. Most of you have answered. And let's see what the consensus is. I get accounts payable. That's a good start. That's a good place. And outstanding. Everybody got it right. Thank you. So I got AP. Now the question is, what the heck do I debit and what the heck do I credit? Well, we'll start with pick one of the accounts. Supplies. Do supplies go up as an asset or supplies go down as an asset? You got thumbs up. Thumbs up. Debit to assets. Supplies. We got a winner. So whatever is on the other side, in this case accounts payable, has to be a credit. So we got accounts payable credited, we got supplies debited, we're on our way, there's our journal entry. So now we can answer the question. Will purchases of office supplies on credit? Let's see, the credit is this thing right here, the one on the right, 500 on the right, that's accounts payable, there we go. We got nothing to do with cash, nothing to do with common stock. We're not debiting payables or debiting receivables, we're crediting payables. So the easiest way to answer these questions, just go ahead and write down the journal entry. A credit is used to record an increase of all of the following except. So again, we look at our credit is an increase. A credit happens to be an increase to liabilities. It happens to be an increase to equity. It has to be an increase to revenue. It happened to be a decrease to assets and a decrease to expenses. So the question being, credit is used to increase all the following. So is accounts payable? Yep, that's up here. Wage expense, that's over here. That's not going to work. Common stock, yep, that's equity. Service revenue, yep, that's a revenue account. Unearned revenue, yep, that's over here as a liability as well. So the only one that doesn't fit this picture is wage expense. So wage expense will decrease with a credit, not increase with a credit. So we go on to number 3. When cash is received from a stockholder in exchange for common stock, the transaction is recorded by debiting cash and crediting what? All right, so let's go back to our pictures and say, let's text it in. So when we invested $30,000, we got cash and something else. We got an initial investment, so $30,000. Do we debit cash or credit cash? Well, got the answer. Debit cash for 30 grand. Then we got to credit something. Now this is an initial investment. So my question to you is, are we crediting a liability account, an equity account, revenue account, or expense account or asset account? Obviously, if we got $30,000 coming in cash, there's our equity common stock. So we're going to debit our common stock or additional paying capital with that $30,000. We're going to credit that. So what here, when cash is received from stockholder in exchange for common stock, the transaction is recorded by debiting cash and crediting equity account. Only possible answer. No, it depends about it. Final question. Prepaid accounts, also called prepaid expenses. Where do prepaid expenses go? Well, prepaid expenses looks like they go somewhere. They're not expenses here, they're actually prepaid expenses, prepaid insurance, prepaid rent, prepaid plane tickets. If the flights don't fly, we get our money back. If we cancel the insurance policy, we get our money back. And eventually, when we do on our adjusted journal entries, we'll transfer from prepaid expenses to actual expenses for the period. We'll have our unearned revenue transfer to actual revenue in the period. We'll talk more about that very shortly. But to answer this question, prepaid accounts, also called prepaid expenses, are generally, are the equity on the balance sheet? No, we put it over by the assets, didn't we? Payments made for products and services that never expire. Well, insurance is going to expire. I hope that plane ticket is not perpetual on my balance sheet. Promises of payments by customers. Customer that's promising a payment, that's a receivable. They owe us money. That has nothing to do with prepaid expenses. Assets are that represent prepayments of future expenses. There we go. We have insurance expense, but we'll prepay it. We haven't used it up yet. It's got to show up as the asset. And they're not classified as liabilities on the balance sheet either. So there's our 4 questions. That was our quiz. You should be getting fairly comfortable with the terminology, fairly comfortable with the process. This is the foundation we're building. And once you build that foundation, that's going to carry you far for the rest of this class and help you understand what we're getting into. Any questions on your mind? Go ahead.
I didn't have any multiple choice questions. Mine was making income statements, balance sheets, and like the journals.
So what about multiple choice? You don't like the multiple choice? It's kind of confusing.
I didn't have any multiple choice questions. It's like,
oh, you did the wrong quiz? Okay, so that was a quiz marked for 11:30. So you probably did the quiz. Okay, so you did the other quiz. All right.
My bad.
There's another quiz in the content, and maybe I wasn't clear enough. I thought. Show of hands, how many didn't have the 4 multiple choice questions I just reviewed? 1, 2, 3. All right, so we'll work that out, and we'll have an answer by next class. I'll talk to you about that.
Okay, I'm sorry, my bad.
That's okay, it happens, but that's I wasn't clear, so I'll take the call on that. Thank you for pointing that out. Okay, let's go ahead and continue on with rules, adjusting journal entries, and deferrals. So let's talk about what we're trying to figure out. I'm going to share my screen again. I'm going to go over to PowerPoint.
I actually had one quick question.
Sure.
When do the prepaid expenses get transferred to like normal expenses again?
Okay, so if we have, we'll take an example. Good question. If we're doing something like prepaid insurance, and we're going in and we're saying, I'm going to go new share, records, clear that mess off. Okay, so I've got an asset right now, prepaid insurance. The asset side of things. And you want to transfer that down to insurance expense. And David, your question is, when do we transfer that stuff? Well, we're going to transfer it at either the end of a monthly period, a quarterly period, or an annual period. So if we have 100, let's say $1,200 of prepaid insurance for the year. In December, I make my journal entry, cash out the door, credit 1,200, debit my prepaid insurance, 1,200. I've got an asset sitting on there in December. Starts effective January 1. If I don't do anything on January 1, but on January 31st, I'm going to make a journal entry adjustment. So on January 31, I'm going to have to take out $100 and move it from my balance sheet to my income statement. How do I do that? Well, my prepaid insurance is already the debit balance, but I'm increasing my insurance expense, and I'm going to reduce my prepaid insurance. So what happens? Let's do some T accounts. We like T accounts. They're easy to read, easy to understand, they make a lot of sense. Here's my prepaid insurance. It's my insurance expense. What just happened? I had started with $1,200 in prepaid. I started with zero in insurance expense, and then I made an adjustment. My adjustment was $100 credit to prepaid insurance and $100 debit to insurance expense. So now the net balance on my prepaid insurance is $1,100. And my insurance expense is recognizing 100. So the timing, the question, the short answer is end of the month, typically. Although things like depreciation, some companies just do it annually and make these adjustments annually.
Okay, so just the end of the given time period.
I'm going to go through adjusting journal entries. And I'm going to give you the magic rules. There's 2 rules. I mentioned them last class. And I wanted to review them with you. So we have AJEs, also known as adjusting journal entries. The 2 rules, I said, one account is never hit for adjustments. And the other rule is, start with never, ever. And we had 1 from blank and 1 from blank. My question to you is, in an adjusting journal entry, do you recall what I said last class? Is never, ever adjusted. It's never, ever hit from an adjusting journal entry at the end of the month. We're adjusting accounts throughout the month all the time. We're buying stuff, selling stuff, getting paid, paying people. That's happening during the month all the time. Anybody remember what account is never, ever going to get hit? Cash. Well said. Cash is the account that we do not want to adjust at the end of the month. Now, cash, you might say, well, my bank just sent me a statement and they got some bank charges on there, $50. That is an adjustment to cash, but it's not an adjusting journal entry, an end of month adjustment. That could be a little confusing. Cash will change. Cash goes up, cash goes down. But for an AJE, an adjusting journal entry, never, 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 ever adjust cash. The other catch is there's 2 types of accounts that are hit on adjusting journal entry. And we said it last class. Anybody recall? One was from the balance sheet and one from the income statement. You saw the last example. We moved prepaid insurance from the balance sheet down to insurance expense on the income statement. All of these take the form of adjustments, moving things from a balance sheet typically to an income statement, reporting it somehow, some way. The other 2 broad categories of AJEs are deferrals and accruals. A deferral has already been recorded that we need to adjust. So let's do some examples of that. Well, our insurance was a good example. We actually paid the bill. We paid $1,200 in December. Credit, cash, debit, prepaid insurance. Well, now it's sitting as an asset. We need to make a monthly adjustment, $100 a month for the next 12 months to use up that insurance. Okay, so we're on the same page. We're making sense of that. On the other hand, we also have unearned revenue. Well, we'll give some examples here. So we might have prepaid expenses. We also might have something called unearned revenue. We have a liability. We get a $5,000 deposit from a client. We debit the cash for $5,000. Thank you very much. We have $5,000 unearned revenue as a liability. That unearned revenue will eventually become earned revenue as we perform the services or do what we committed or deliver what we promised to deliver. Until we do, that money's due back to the customer. It's a liability. It's an obligation. The customer cancels the order, depending on our contract, it's likely they're going to get a full refund. That's money we owe them. But once we ship them something, or we perform the actions, we do the services we commit to, we're going to make that adjusting entry and reduce the unearned revenue. We're going to, if you start with a credit of $5,000 of unearned revenue, we'll debit $5,000, or debit however much we use, $1,000 worth of work. We'll debit $1,000 out of unearned revenue and credit actual income statement revenue, maybe service revenue that will transfer. So we're getting $1,000 off the balance sheet, moving $1,000 into the income statement. So those are pre-recorded. Those are already been on the books. And we're just making adjustments as we use them up or as we offer or provide the services. Then we have something called accruals. When I mentioned last time, the buzzword I like to use for accruals is estimates. What are we estimating? Well, what happens at the end of the month? We go ahead and, you know what, our employees work and they expect to get paid, reasonably so. But what happens if we don't pay them until January 5th for work they did the last 2 weeks of December? You as an individual, cash basis, 1040, you don't see that cash on your W-2 until next year. But your company has to record maybe $10,000 worth of wage expenses. They get a pretty good estimate of what you did. They have the hourly folks, they got the salary folks, maybe some took vacation, they recorded whatever. Yeah, they got a pretty good idea, it's now $10,000. But nobody got a bill for 10 grand. Nobody was paid 10 grand yet. So they're gonna put $10,000 on the books, they're gonna book an expense of 10,000. So we're gonna debit the expense for 10,000 and credit wages payable. Now, wages payable, it's like an accounts payable. We're going to pay our employees pretty soon. We pay them on January 5th, as I said. But as of December 31, we got a payable and an expense booked. We've got it recorded, but we're estimating it. Same thing happens if you take out a loan. Some notes payable, you don't pay interest by the month, you pay at the end. Then December 1st, we took out a 90-day note, 90-day loan. During December, we have a month's worth of interest expense. Nobody sent us a bill for interest expense. Matter of fact, in January, we don't get a bill for interest expense, 60 days later. 90 days later, we don't get a bill, but we agreed to pay in 90 days the value of the note plus 3 months worth of interest. That was our promise, that was our commitment. You give me 10,000 bucks, I'm gonna give you 10,000 bucks plus another 300 in interest or whatever I committed to. So what's happening? You write a check for 10,300 3 months from now. But that $100 in interest that was accrued or estimated for December needs to be recorded. Again, we're not getting a bill for the interest. Bank doesn't send us a bill, or wherever you loan the money to doesn't, you borrowed the money from, doesn't send you a bill. You just know that on February 28th, you're sending them 10,300 bucks. 100 of that is a December expense last year. 200, 100 for January, 100 for February, that's for next year's expense. And we'll record 200 in expense, plus 100 off the payable, and we'll see how that works a little later. But these are what we need to worry about in our adjusting journal entries. And again, we're never adjusting cash. We didn't pay the interest at December 31st. We're just recording the amount of the expense for the interest. And we're doing one balance sheet account, one income statement account. We have the payable, and we have the expense. Any questions so far? Yeah.
So what would that go under, what more separate with the back in?
Oh, okay, let's do that. Let's do a December 31 adjustment. I told you I had 100 bucks and 100 bucks. All right, so what does that mean? Well, I'm going to debit my interest expense, and I'm going to credit my interest payable. Now it's going to get interesting. What happens on February 28th? I mean, it's already interesting. I'm an accountant, what can I say? On February 28th, what's going to happen? By the way, we did on, let's do our December 1st entry up here. 12/1. We got $10,000. $10,000. So we got it in cash. And we have a notes payable. Good question. Let's see how this flows. Where's this all work out? So December 1st, 90-day note, $10,000 came in the door and we owe the money. We're in balance. We got a liability for 10. We've got cash of 10. December 31st, we have to make that adjusting journal entry. I told you it was $100 worth of interest. We'll worry about calculating it later. So I got $100 in expense and $100 in payable. This should be indents a little more, just to be clear. Don't do it after the fact, so that's okay. So what's going to happen? We've got $100 in interest expense that I'm recording, debit the expense, credit the payable. Now on February 28th, how much am I going to pay out? Well, I have to pay out all of it. I have to pay out $10,300. But now, how do I break this down? I told you in the current year, my interest expense was for 2 months. I got January and February interest. I get $200. And I have an interest payable from last year of $100. And I'm still up by 10 grand. So what's that 10 grand? I've got a notes payable, 10 grand. So it's repeatable. So that's my journal entry. Now notice what happens on February 28th. My balance sheet, my notes payable of 10,000, my liability goes away. I'm clearing it. My cash goes down, credit 10,300. My interest expense, I'm not recording $300 in interest expense in February. I'm only recording $200 in interest expense because that's January and February interest. Last year in December, I already recorded $100 of the interest expense. I still have $300 in total expense over those 3 months. But in December, I recorded 100 of it. And now in February, I record the other 200. Or if I was doing adjusting entry every month, I might have 100 already into payable. I did in January. And then I have 100 more in February. Clearly payable. Yeah.
Now, is the question back about moving one from debit to credit, and saying beginning of December.
Good point. But that's February 28th is not an adjusting journal entry because it has cash. God, you told me no cash, and that is correct. So that is an actual, I paid off this note. That's done. That's a transaction. This is not an AJE. So thank you for pointing that out. My February 28th adjustment is not an AJE. It's a payment of the note that's obligated. It could have been February 26th. It could have been February 24th. Whatever the note due was, I paid it. So that's not an AJE. My AJE is 1231. Now I might have had a 131 AJE for $100. Yeah, I'm doing it monthly. I'd have interest expense in January for $100, interest payable for 100. So my payable goes up to 200. And right now, I'm going to pay off the 200. I'm going to incur another $100 in expense, but I'm paying off the note. So the only AJE here is December 31st. The other two are actual transactions. I got the money. I got $10,000 in cash. That's not an adjusting journal entry. That's $10,000 in cash. Maybe instead of a notes payable, it might have been an equity investment. Maybe it was common stock. Someone bought some stock in my company. And that's okay too. But right here, cash is not an adjusting journal entry. Cash is not an AJE on December 1st or February 20th. Are we clear on it? Are we on the same page? Okay. So let's go ahead and take a look at some of the, okay, we talked about recognizing revenue. Revenue recognition requires goods be recorded when the goods or services are provided to the customer. The amount is expected, received, and we're good to go. So when we recognize revenue, we're on track, we're good to go. Recognize expenses, we have this matching thing. That's why that interest had to be matched in December. Because we borrowed the money, we used the money, and the expenses associated with December had to be recognized of $100 in interest. January and February had to be recognized and brought proper period. So here's our standard. We have deferrals and accruals. Deferrals are already recorded numbers. And accruals are estimates of things we haven't put on the books yet. So we're gonna have to record that stuff. Let's go through a couple. Here's some adjusting journal entries. Prepaid expenses. Well, we just did something like that before. We had prepaid insurance, supplies inventory, rent. So here's we debit the expense account, and we credit the asset when we adjust it. One balance sheet account, one income statement account. So let's see what's going on. This is 24 months, not 12 months worth of insurance, but 2 years worth of insurance, beginning on December 1st. So we have a prepaid insurance debit. What's the journal entry look like? We're going to debit 2,400 and credit cash. That's not an adjustment, that's paying a bill. But now we're going to amortize, or we're going to estimate how much every month we use up. We're using up $100 a month. 2,400 divided by 24 months is $100. So every month we're going to have an AJE for $100. The two accounts that are going to get hit are prepaid insurance and insurance expense. What does that mean? Well, my prepaid insurance, my net's now going to be $2,300 after the first month. And my insurance expense is going to be $100. We're using up 1 month's worth of insurance. And here's a journal entry. Debit the expense, credit the prepaid. Pick a side, the expense is debited. That's usually the easiest one to target. No cash changes hands, so we can't say cash went up or down. That does not make any sense. I'm adjusting journal entry. Supplies. We bought $9,700 worth of supplies. It's on the shelf, sitting right here. We go count at the end of the month and we have $8,600 worth of supplies. What that's telling us is we used up 1,050. Okay, so 1,050 of stuff was used up in the business. We're gonna have to expense 1,050 worth of supplies. What's the journal entry look like? Debit the supplies expense, $1,000. Debit the expense. And you can see supplies expense is going up. It's a debit balance. Debit makes it bigger. And our supplies, which is normally a debit balance, we have to credit for 1,050 because we only have $8,670 stuff on the shelf. That's all that's for. We used up 1,050. So we're calculating how much we used up based on a physical count. We just took an inventory, looked at it. Yeah.
And just make sure, the usually pause is debited, and the adjustment to be credited from that on giving your balance on the adjustment made on that. So just the credited here is going to be debited on, right?
Debits equal credits. We've got to be in balance. But you're right. You started by writing the check. I wrote a check or accounts payable for $9,700 in supplies. Debit my supplies inventory. I'm going to credit my cash or accounts payable. One or the other. Either got it on account or I paid cash. So now I got $9,720 sitting in my supplies account, sitting in that ledger that I've got all this stuff sitting on the shelf. Now, sometimes you'll say, wait a minute, I just took this off the shelf, $1,000, expensive right now. And you can make that adjustment saying I'm using it as we go, take it out of supplies, make the expense, make the adjustment. But we're doing month-end adjustments, and we're not saying, we don't know, you took a ream of paper, you took 6 pens, you took a stapler, and you took stationery and business cards. I don't know how much that is. I'm not going to nickel and dime and track it all. But I know we use it. When I went over and counted, based on the paper left, the toner left, the cartridges left, the staplers left, we used $1,000 worth of stuff. Because I have an 8670 balance, my ending balance. I will go in and say, that's my adjustment. I need to reduce my supplies from 9720, where it started, to, oh yeah, we have an 8670. I just counted it. How much do we use up? Well, add, subtract, multiply, divide. $1,000, 1,050 is what I used. Does that make sense? It can be real confusing saying, well, one, I calculated the ending balance and I debit that. There's $100 in insurance. The other one, I have to calculate the difference. And that can be a little confusing. I respect that. So let's talk about depreciation. We buy a building, we buy a vehicle. There's something called a salvage value. Buy a $25,000 car, maybe it's worth $5,000 at year end, after 5 years of it. So we're going to depreciate. The depreciable amount is $20,000 for that car. 25 minus 5 is 20. And if we do it over 5 years, 20,000 divided by 5, I think that comes out to about $4,000 a year. That's going to be the expense that we depreciate through our vehicle. So useful life, how long are we expecting the asset to produce revenues? Salvage value could be a scrap value, or it could be the selling price after the useful life for 5 years. But here they got a $26,000 vehicle. They think it's going to be worth about $8,000. So 26 minus 8 looks like it's $18,000, and they're doing monthly depreciation. So what happens? 26 minus 8, 18,000. That's the net amount we need to depreciate. But what's happening here? We have on our books, and we'll take a picture here. We have on our books an asset, we'll call it vehicle or equipment or machine. And then we have something called accumulated depreciation vehicle. If you recall, I told you that was a contra asset. It was an offset to the asset. It was a credit balance instead of a debit balance. It gets deducted to determine what's called the book value of the asset. Eventually, all $18,000, we had 28, it was 26 minus 8. So $18,000. That's the book value. We're going to eventually have $18,000 in accumulated depreciation, $26,000 in vehicle for a book value of $8,000, maybe after 5 years. And that book value is going to stay until we get rid of the car or the machine or the equipment. Let's go back to seeing what that looks like live. We go back and say 26, oops, we're too far. So we're going to go in and say, we're going to depreciate this thing. We're going to adjust it. Comes out to $300 a month. 18,000 divided by 60 months is $300 a month. So here's our $300 adjustment. The equipment account is not going to change. $26,000 equipment. But the accumulated depreciation account every month is going to go up by $300. And our depreciation expense is going to go up by $300. So there's our journal entry. Debit the expense for $300, credit accumulated depreciation for $300. So that is going to depreciate the equipment, and eventually we'll get up to $18,000 worth of accumulated depreciation. After 3 months, here's what it looks like in the balance sheet. $26,000 less $900, 3 months of depreciation yields a net book value of $25,100. After 3 months, we're there. Let's talk deferred revenue. Unearned revenue, cash received in advance. Oh, we got a deposit. One of my customers gave us $5,000. I'm going to use up some of that. Oh, here, I'm sorry, in this case, $3,000. I got cash, $3,000 asset. Unearned revenue, $3,000 liability. I haven't done any work yet. I didn't earn any money, but I got paid. It's kind of nice. I may have to give it back though, if for some reason I don't provide the services or the products. So here's my unearned revenue of $3,000. I already have $5,800 from other transactions. Don't get confused by that. But I actually did $250 worth of work. My ending balance for the customer is $2,750 that I owe them. That's my liability. So my adjustment is $250. So I'm going to go ahead and debit my unearned revenue, reduce my unearned revenue by $250, and credit my actual revenue at $250. So we've got our balance sheet account, the unearned revenue. We've got our income statement account, consulting revenue. Now we move forward. Any questions on that? No cash changed hands. How about accrued expenses? This is our wages payable. We calculated there's $210 owed on December 31. So we credit the payable and debit the expense. Again, the expense is probably the most obvious. My debit expenses, they go up $210 worth of 3 days of salaries or wages, and I credit the payable. I owe the money. Now, what happens on January 9th? Notice this is a cash transaction. This will be the last thing we talk about today. The same way that I had that interest paid, plus the principal on the note paid, plus the cash paid, and cleared it on February 28th, this is January 9th. I wrote the paycheck for $700. 210, 3 days have already been recorded in December. That's the payable. But I have 7 more days in January, 490. So I'm going to have 7 days in expense this year and take care of the 3 days from last year. There's like 10 total days that this paycheck is being paid for, and that my cash being relieved of the 700. So that's where I want to wrap it up at this point. Open the floor for questions. Anything on your mind?